I think one of the more interesting things is we've got a lot of confirmatory evidence here over the course of the last month of the stronger for longer environment, confirmatory evidence that the Treasury will continue to bring significant duration supply into the market and increase that in Q2, and that the Fed is unlikely to be nearly as easy as market participants had expected coming into the year. And yet, when you put the mix of things together, we really haven't had that big an adjustment in asset market pricing to reflect that reality, that confirmatory reality. And so certainly markets have moved, and they've moved a fair amount from the start of the year. Over here on the left-hand side, I have stocks minus long duration bonds. That's moved, actually, that trade has moved almost 20% in the favor of stocks relative to long-term bonds. And it was a trade that it was highlighted right to kick off the year in our 2024 outlook, as well as highlighted in our previous webinar to kick off the year. So that's moved a fair amount, but at a big picture level, we're still looking at stock prices relative to bond prices that are roughly where they were last fall. And so we've retraced the drawdown, which looked inconsistent with the macroeconomic data that we're seeing, but we haven't gone meaningfully above where we were in October. And remember, since October, we've had, almost 100 basis points decline in bond yields and stock prices up 20%, all of which, and an economy that continues to roar along. You put that all together, and what do you see is you see a circumstance where there's probably more room to run on the stock versus bond trade that has done well this year. And then on the right-hand side, of course, we've got what cuts are priced into 2024, which we continue to see about 125 basis points of cuts priced into 2024, 5 cuts, which is certainly possible. But if you think about the macroeconomic reality of this level of strong growth and continued lingering concerns about inflation, what you'd have to expect, and plus the Fed that's made it somewhat clear that cuts aren't going to be coming till the summer unless something meaningfully changes. What you basically see in this mix of things is that you're basically pricing in a cut every meeting starting in the summer, and that's certainly possible. But given what we're seeing in the data, and given frankly what the various members are saying, it still seems overstated to expect 5 cuts in the market today. So these two trades, which I think are the two most obvious stronger for longer trades, have been in the money since the start of the year and look as though they have more room to run given what we're seeing.